Off to chapter 9. Last chapter, we talked about budgeting, and this is something that most companies do. It's something that if you become a manager, you'll be responsible for. And so, in this chapter, we're going to cover what's called flexible budget and performance analysis. And the main theme here is that a company will come up with a budget and they will assume a certain amount of sales. So we saw in last chapter that everything is dependent upon the sales budget. So it's rare that a company will actually sell what they budget. I mean, that just hardly ever happens. And what we want to find out though is if we have higher or lower volume, if we have higher volume, then naturally we should have a higher profit. But should we or did we achieve a higher profit with the same profit margin, which means that as volume grew, we still utilized our resources efficiently. A rising tide will lift all boats. So again, if you do more volume, then you should naturally have a higher net income, but you want to have a higher net income and still be efficient. So that's really what we're going to be comparing here. We're going to be talking about flexible budgets so that we can look at different volume levels and see what profit we should have made at that level and did we achieve that. So the variance analysis cycle is we prepare the performance report. Okay, we analyze the variances. We ask questions. Okay, if salaries were higher than what they should have been at this level, then what is the problem? We identify root causes and then we take action and then we conduct next period's operations. So every month we're reviewing this information and we're trying to come up with solutions. And if you are in a situation where you're underperforming, this is really what's going to be important is okay, things happen, but what are you going to do about it? How are you going to overcome these issues? So we're going to prepare a planned budget and a flexible budget with one cost driver. So planning budgets are prepared for single plan level activity. So we're going to do X amount of sales. And performance evaluation is difficult when actual activity differs from the plan level activity. So again, a rising tide will lift all boats. Flexible budgets must be prepared for any activity level in a relevant range. Again, one drive-through window, two drive-through windows, we only have certain capacity. And we show costs that should have been incurred at that level based on our original budget. This helps managers control costs so that, hey, you're doing more, but you're not utilizing the resources like you should. And so it should help to improve our performance evaluation or to improve our performance. So let's look at Larry's Lawn Service. Okay. They provide lawn care to a planned community. All of the lawns are about the same size. Larry estimates he's going to mow about 500 lawns. And because all of the lawns are the same size, he believes that is the main cost driver, number of lawns, and also the main revenue driver. So Larry believes he's going to plan to do 500 lawns. And so he's charging $75 a lawn. And so at 500 lawns at times 75, that will be 37,500. For wages and salaries, there's maybe Larry or some type of overhead that is not variable with the cost of the lawn. And so that's the fixed component. And then you have a variable component is $30 times per lawn. So it's 30 times 5 is 15,000 plus 5,000, 20,000. Same thing here, gas and supplies. If you don't mow lawn, then you really don't need gas. So that's $9 per lawn. And then equipment maintenance, $3 per lawn. There's probably some fixed component here, but he's just gone ahead and saying, well, it's uh, 3 times the lawn. But you would expect to have more maintenance as you mow more lawns. And then these are more fixed costs: equipment depreciation, insurance, office shopping, rent, utilities, etc. So based on mowing 500 lawns, Larry expects to make $5,000 profit. So this month, he actually ends up mowing 550 lawns, and that's an increase of revenue of from 37,500 to 43,000. Wages went up to 23,500 from 20,000. So he made 6,450. And did he use his resources efficiently? One way to look at this is to look at, we saw in the cost volume profit analysis and other things, is that we should be able to look at the variable cost and the variable overhead and then determine whether we hit our margins. So let's look at this. So we've got revenue of $75, so that would be the variable overhead or variable revenue. And then for each lawn, it should cost us 30 plus 9 plus 3. And so that's 42. So 75 minus 42 is 33. So you would expect to make a profit of 50 lawns um, times, okay, let me clear all this. 50 times, what did I say? 32, 43 times 43 equals 2150. Let's make sure I did this correct. So we've got 30 plus 9 plus 3 is 42. And so that's 33 times 50 more lawns. And so that's 1650. All right. Okay. So we would expect if we did 50 more lawns that our profit should be 1650 additional. Again, that's variable revenue minus variable cost, so that our profit would be 76 or 6650. And in fact, our profit is 6450. So somewhere along the line, we have increased our cost $200 more than what we would have expected. Now, it could be that some of our assumptions were wrong, or it could be that we just got a little sloppy. And so here's the analysis you can see here. And you can see that in total, all we're doing is comparing budgeted, which was budgeted 500, to actual. And so revenue was up 5,500, expenses were up 4,050, so total operating income was up 1,450. And yet, again, based on our variable revenue and cost, it should have been up 1,650. And you can see here that's favorable. An unfavorable variance that occurs when actual costs are greater than budgeted costs. So if actual costs are greater, then that's unfavorable. If they're less, they're favorable. And so you can see that we do have some favorability here in the, you can't see what's under there. But again, we did more, so you would expect to make more. Since these variables are unfavorable, has Larry done a poor job controlling costs? Well, let's see. At this point, we cannot answer the question because the actual level of activity is greater than the planned level of activity. Now, we did the variable analysis and know that, hey, something's off. We should have made $200 more. And now we're going to actually look at some calculations to show that. So, how much of the cost variance are due strictly to higher activity? Which means that if we think it's $30 per lawn, then just because we did more, we should have higher labor costs of $30 times the increase in the number of lawns we did. To flex a budget, we need to know the total variable cost change in direct proportion to changes in activity. and total fixed costs remain unchanged. So in other words, our variable costs were $42. So did our cost go up 42 times the increased volume, 50, or did they go up more or less? So let's prepare a flexible budget. And so now we're going to go and based on the assumptions we originally made, okay, $30 per lawn for labor, $9 for gas and supplies, $3 for equipment maintenance. Our revenue should have been 41,250. Our cost should have been 34,600 for a total operating income of 6650. What should the total wages and salaries cost be in a flexible budget for 600 lawns? All right, so we have $5,000 fixed cost, and then we've got $30 per lawn, and we're going to do 600 lawns. All right, that's 18,000, and we add the 5,000 of fixed cost, and so it should be $23,000. All right, so calculate and interpret variances. An activity variance arises solely due to the difference in the actual level. So again, $30 times the increased number of lawns, that should be the activity variance. So we're going to use flexible budgeting concept to compute activity variances for this service. So again, this is the information that we have. Our flexible budget says that at 550, we should make 6650. We originally thought we were going to only do 500 lawns, so we're going to see that based on the increase in activity, here's what our activity costs or differences should have been. We should have had an increase in 3750 in revenue, a $1,500 increase in wages, 400 in gas and supplies, 150 in equipment maintenance, and no changes to the other items. Activity revenue increased by 10%, but net operating income increases by more due to the presence of fixed costs. So in other words, we're adding variable profit to each item, and the variable profit we've already covered our fixed costs. So each one, that's that operational leverage we're talking about. So calculate and interpret revenue and spending variances. So we've got the difference. We've got the difference between actual revenue and flexible budget revenue. The difference is a revenue variance. And then we've got the difference between actual cost and flexible budget cost. And the difference is the spending variance. So let's use flexible budgeting concepts to view this. So here we've got now instead, originally our budget was for 500. So now we've gone, okay, but if we had originally budgeted 550, then this would be our flexible budget. Revenue was up 1750, that's favorable. And let's see, we should have been up 3750. Let's look at this again. Okay, so favorable revenue budget of 1750. All right, so anyway, so we made more than we would have made originally. So we charged more than $75 for the 550 lawns. So that's a good thing. In fact, let's see, that's 43,000 divided by 550 is, so we actually were able to charge $78. So that is really good. We've got more revenue than we thought. Unfortunately, we thought that we would do $30 in revenue or $30 in cost per lawn, but we did more. So if we subtract the 5,000 from the 2350, so we got 23,500 minus 5,000. Okay, that gives us a total of 18,500 variable cost. Divide that by 550. And so we actually paid 3363 or 3364 in labor cost per lawn. So we got a little more revenue, but it also cost us more. Gasoline supplies were, let's see, 5,100 divided by 550, and so that cost us $929.27. Maintenance was lower, so that's good. We didn't. Our utilities were lower. We don't have much control over that. And our insurance was actually higher. Really don't have a lot of control over that either. But that really is the difference here. I mean, overall, these kind of absorbed the difference here, and looks like the insurance was the main culprit. So again, looking at what we thought we would have budgeted at 550, we got better revenue, but our wages and salaries, gasoline and supplies were higher, maintenance lower, saved a little in the utilities, but we had an insurance payment that was higher. All right, so let's use budgeting to combine the revenue and spending variances reports. And so here you can see the difference between the actual results and the flexible budgets. And then here you can see the difference between the flexible budget and what we thought we would do. So we thought that we would have an increase in 3750 in revenue, but really the difference is going to be 3750 plus the 1750, and that's the difference between 37,500 and 43,000. So the difference between this number and this number is going to consist of the activity variances and then the other variances that aren't accounted for spending. So 23,500 minus 20,000 would be 3,500. So um, this can be explained by just simply more activity. This means, well, we were off based on what we thought we should have done. And so you can go back and go, well, did the labor cost increase because we had to pay more? Is it because we were less efficient? You know, what is the cost of that? So if I'm Larry, I'm going to be looking into this. Gas and supplies. Again, did we have a lawnmower that used a lot more gas than what we thought? Is it the fact that the cost of gas went up, which we really have no control over that? And so really our budgeting assumptions would be incorrect. And we would need to really then look at controllable versus non-controllable. If it's wages and salaries went up because that's just the market, then what can we do about that except try to make the workers more efficient? If it's the fact that they just were slower, maybe they were tired, maybe they worked so much that by the end of the day they just couldn't weren't as efficient. And so then you go, well, that's fine. Maybe I need to hire another worker, get another lawnmower, etc. But it gives you again the idea of, all right, this is what I should have done, and this is really the variances that I need to look into. So nonprofits may receive funding from sources other than the sale of goods and services. So revenues may consist of fixed and variable elements. You've got state funding, you've got tuition and fees, then you've got donations, which you really don't have any control over. State funding, usually you at least have some idea. Tuition fees, you don't really know until you find out how many people are going to actually be going to school. Um, Although you can look at trends, and then endowments, you don't know, if you have a major donation campaign going on, that might increase your donations. Um, Performance reports are often prepared from cost centers. So in this case, you may not have revenue, but it will go, well, you did X amount of, let's say, service calls. And so you don't have revenue for the number of service calls, but how much did you spend per service call? And although some of that may be that, hey, you weren't at capacity, and so if you did more than what you thought, your cost per service call should actually go down. Compare a planning budget and a flexible budget with more than one cost driver. All right. So again, it's just in the example of determining what your product costs are, you start to refine it and determine that it's based on more than one factor. So Larry decides that there's an additional cost driver for hours because he says that the time required for edging and trimming is different for different lawns. So he's going to factor that in. So the lawn is going to be the size of the lawn, mowing is consistent, but each one has different edging requirements, different, blowing the leaves or blowing the grass off, etc. So he's saying that that's going to be a factor as well. So now he's going to go wages and salaries are $5,000 fixed cost plus $29 per number of lawn and $25 per labor hour. And so 5,000 plus 29 times 500 plus 25 times 100 comes up with 22,000. Same thing, gas and supplies, it's um, $6 per hour. And it makes sense, the more you use the blower, if it's gas operated blower, the more gas you're going to use. Same thing, the more you use the blower, the more maintenance you should have. And so here is Larry's service for the actual month ended. And so he did, this is the budget. Uh, Again, for 550, the one before was for 500. So we've got this budget for 500. We thought we should make 5,700. But if we do 550 lawns, we're going to do $7,500 in operating income. So again, the same thing. This is the flexible budget, okay? This is the difference between what we thought we would have done at 550 lawns cut compared, or this is what we would have budgeted for 550 lawns, okay? You see this 7,500. This is the budget figuring 550 lawns and 100 hours of blowing. And so we felt we should have had a favorable budget of 1850. And now we look and go, well, we actually did the number of lawns of 500. We actually did the number of hours of 200. And so based on this, the difference between these two, and really, I guess you could go and go, well, what if we put in a flexible budget of 200 hours? I mean, that really would be more accurate, I think. But they didn't. They're just going, well, we did $200 more. Revenue is 43,000. So we actually we had less revenue per hour or per number of lawns, per number of hours than we thought we would have with the flexible budget. So that was unfavorable. And then we spent more wages than we thought we should have given these numbers. Um, and we got gas and supplies, more number of hours. You would think that would happen. Again, shop and utilities were a little less, insurance was higher. So we really made 1,800. Well, we made 6,450 minus 5,700. So we did make $750 more, but we should have made 1,800 dollars more, and actually probably a little more because we did the number of hours. But again, this is the variances just based on the activity, and we should have had an increase of $1,800. We didn't. We only had an increase of 750. So the reason is, and really, wow, look at that, 750 um, lower revenue. So this is probably explained with the higher number of hours here. It really would probably be better to have a budget that consists of the same number of hours, same number of lawns, and then make the comparison. But now you can go and say, well, why was this? Was I not able to charge more? Um, you know, did I charge less for the number of lawns, etc. And then obviously I used more labor, but again, you expect to use more labor if you do 200 hours versus 100 hours. All right. So these are the types of reports, but it gets into a little more detail and then allows you, instead of just saying, well, we made more, but our margins should have been higher, this now gives you more ammunition, and it gives you more ability to really look at your business and go, hey, I need to look at my gasoline cost and why is it higher? Again, if it's just the fact that gas has gone up, not much you can do about that on the short term. And then labor, why is the labor? If it's because the market is higher, then I'm not sure how much you can do about that. But if it's because of inefficiency, that is something you can probably adjust.